The term not-for-profit can be confusing. Some people think that a not-for-profit club isn't allowed to make money. Not-for-profit is very different from no-profit. Not-for-profit simply means that an organisation can't distribute its surplus assets among members. Instead, profits must be reinvested in delivering the organisation's purpose, which are the objects in the constitution. There's no limit to how much money a not-for-profit organisation can make. While you can delegate responsibility for keeping financial records and financial reporting to the treasurer, the entire management committee is accountable for your club's financial management. This is why all money spent by your club must be either approved or ratified by the management committee. Properly managing your organisation's money should include keeping accounts and records, monthly and annual financial reporting, setting prices based on sound business principles, collecting your fees on time, budgeting, risk management and insurance. Under Queensland incorporation legislation, your club must keep financial records including a cash book, receipt book, bank statements, asset register and petty cash book. Your records should be easy to find and understand. All financial records for your club must be retained for at least 7 years. Every not-for-profit organisation, no matter how small, can benefit from budgeting. You can create a budget by looking over your actual income and expenditure from recent years, taking into account things you know are likely to change in the coming year. It's wise to be conservative when estimating income and realistic when estimating expenditure. After each financial year, your management committee must prepare financial statements, present these to members for adoption at the AGM, and lodge your annual return with the Office of Fair Trading. Your AGM must be held within 6 months after the end of your financial year, and the annual return is to be lodged within 1 month of this meeting. In Queensland, an incorporated organisation may be classed as a Level 1, 2 or 3 association, depending on its current assets and turnover. Each level of association has different financial reporting requirements. Current assets include cash and other assets that can be quickly converted to cash, such as stock for sale. Total revenue represents all income during a financial year before any expenses are deducted. Level 1 associations are those with current assets or total revenue of more than $100,000. These organisations must have their annual financial statements audited. Level 2 associations have current assets or total revenue of between $20,000 and $100,000. As a minimum, these organisations must have their annual financial statements verified by an accountant, auditor or other approved person. Some Level 2 associations still choose to have their financials audited. Level 3 associations are those with current assets and total revenue both of less than $20,000. These organisations may simply have their president or treasurer verify the financial statements. If you need to have your financial statements audited or externally verified, your auditor or verifier must be appointed at each AGM, and the person you appoint must be at arm's length from the club. For instance, they can't be an employee of the club or closely related to a committee member. Because every management committee member needs to stay informed about your club's financial position, keep an eye out for red flags, such as an unexpected drop in revenue or dramatic increases in costs, money showing up without knowing where it came from, or vague answers to questions about the club's financial situation. Even though most not-for-profit organisations run on fairly tight budgets, good financial management is still crucial. Having a good understanding of the basics of financial management can make your job as a committee member both easier and much more rewarding.